Welcome to the Real Estate of Things podcast. I'm your host, Dalton Elliott. Kevin Kim, one of my favorite attorneys in the whole wide world. How are you?
I'm good, my friend. I'm good. How you doing?
I am well. I was on your wonderful podcast a couple months ago for the recording, the Lenders Lounge, right?
Yes, sir. Yes, sir.
I love it. So everybody listening, go check out that podcast. Always great private lending insights there. You're a partner at Geraci Law Firm, right?
Yes,
I've
sir.
known about them as long as I've been in this space. One of the preeminent firms in the private lending space. You lead their corporate and securities practice. Did I have that right?
Yes, sir. Yes, sir. You did
What
your homework. I like it.
I take notes. I stayed up all night. I crammed for the test.
Nice.
So what all goes on in the corporate and securities practice? What is that? What is it?
So, I mean, everyone knows Geraci Law Firm as being, primarily focused to serve the private lending industry. And so, unlike banks and, other financial institutions, a lot of our clients need to raise capital. And so my primary focus as the department chair for Geraci's corporate and securities team is our fund formation team. So we do a lot of fund formation and other kinds of securities offerings of all types across the country for lenders. And that's allowed us to really grow our footprint nationally. Most of my clients are no longer in California anymore. I have more clients in Texas, Florida, and Seattle than I do in California combined. And the nice part is that, it's pretty across the spectrum. So you can be a brand new lender, just been done a few deals yourself and want to, kind of get more serious and start up a fund, or you can be a shop like Lima One or other ones, and you want to, either clean up, improve, or upgrade your existing product offering from an investment perspective. And lately with the industry being on fire, so is the demand. And so a lot of investors have discovered our sector as a really great place to invest. And so lo and behold, so is our practice growing as well. But beyond lending, we also work with real estate investors, developers, and family offices on the real estate side of things. And so, real estate syndications, your typical multifamily value add syndication, all the way up to, your nationally held, REITs that are meant for holding rental properties. We do them all here. And we also do some esoteric stuff like opportunity zone work and EV5 work, because at the end of the day, it's tied to real estate, right? And so my background is primarily in real estate and finance and banking. And my law school, I guess the 3 years in law school, I was exclusively focusing on transactional, corporate, and security. So lo and behold, those two melded together when I joined Geraci back in 2014. So
there you go. So you were not the attorney I call if I'm in Vegas, gets too rowdy, get locked up.
Yeah, I have a friend for that. So if you do happen to be, if we have all our friends in the space, right? If you ever get in trouble in Las Vegas, actually one of my really good friends, I just went to his wedding. He's a very, very well known attorney, practices in Las Vegas, and get you out of hot water. So let me know. I'll call him up for you.
Hopefully never needed, but it's always good to know.
You never know. Yeah. Vegas is a crazy place. Never. A lot of bad things happen there.
That's true. So you touched on one thing, which has been a cornerstone of the last 12 months. Oddly enough, in the middle of a global pandemic is when all this transactioning is happening, but it has been buying season for heavy hitters. If you got money in the pocket and you want to get into this space, why don't I just buy a lender who's doing hundreds of millions or even $1 billion and a half a year? I'll just buy the firm and add them. My day job, working as a director at a private lender company, Lima One Capital, that happened to us, right? MFA, publicly traded REIT, real estate investment trust. They acquired us over the summer. And, we do $1.5 billion a year. So you
guys weren't the only ones. Past year got acquired. I mean, there were like, headline level acquisitions. You guys were the big one for the year, but there were a lot more, and we're going to see a lot more coming. I would say in the next 3 months, before the end of the year. And then first quarter after that, I mean, you're right. Nail on the head. It is buying season, and you'd be surprised who the buyers are. Right, your guys' acquisition was kind of like, okay, that makes sense. We kind of saw it coming, right? And it was a logical expansion of the investment. But man, you're starting to see a lot of attention coming from institutions and, even retail operations that, it feels like, oh, they were really sad they missed the boat 3 years ago, and
Yeah.
this is their opportunity to really jump in. And yeah, it's very fraught, and up and down the spectrum too, right? So like, companies as large as Lima One, sure,
Mhm.
right? Even small companies, are doing maybe 20 million a month. Nothing crazy, right? They're getting offers for minority acquisition position from pretty large, institutions and hedge funds, and it's pretty frothy right now. The multipliers are not where they used to be even a year ago. So it's definitely a very interesting time.
Yeah, let's unpack that. So you
Yeah.
said, a lot of groups that you wouldn't expect. Us getting acquired by a company that had a stake in us previously. They're a real
Hmm.
estate investment trust. We lend on real estate. Makes complete sense. What
Right.
what are some examples of other types of groups that are coming in and uh, our space is grabbing their attention and
Yeah.
they're jumping in? Not names
I mean,
necessarily,
I
but
can't name names. I obviously can't
right.
name names, but
Yeah.
the interesting part. Well, I mean, I guess I can name this. The Civic acquisition was kind of a head scratcher at first, but then it's after I interviewed Bill on my podcast, he explained the fact pattern, right? Because they had already been buying loans, so they already had a pre-existing relationship. But that was kind of a head scratcher at first, because when you hear about a bank jumping in
Hmm.
and acquiring a private lender, and that kind of, for me, I used to be a banker, so I see that, I'm like, wow, that's an interesting move from the bank's perspective. But the fact of the matter is that even banks, retail, they actually do depository banking, not investment banking, are looking at this. But also home buyers, right? These large iBuyers that we saw back in the tens, right?
Yeah.
A lot of them have become very institutionalized, have several billion under management, and this is a natural evolution for their business, and so you'll see a lot of that, trying to make deals happen, trying to make moves, sometimes a little bit too aggressively. I think the next year or so, you're going to start seeing companies backed by groups like that. Um, and then at the same time, you're probably going to see some consolidation within the market too. So, I think there's room for that. I think there are companies that have very similar mandates and perspectives and cultures, and it oftentimes makes sense. And one group may dominate one part of the country versus the other, and this could be of all sizes too. But the idea being is consolidation. People talk about acquisition a lot, but we don't talk about consolidation. I think we're going to see a lot of consolidation maybe in a year or so.
Yeah.
Um, Once the valuations kind of calm down, and you're not seeing as much what I would consider uh, balance sheet risk going on. I mean, once that kind of calms down, that's kind of probably happen. But on the flip side, back to what we're talking about, what was very interesting to hear about was the past year now. So we have almost 10 months now for this year 2021. It's we saw a lot of bids happening and conversations happening about very, very large companies. The rumor mill is spinning about Genesis being on the docket for sale.
Hmm.
And I don't know who the buyer is, but we'll see in the next few months how that plays out. And other national shops are likely going to be sold or combined in the next year or so, and it's all going to be kind of one of those, what's that? Like, kind of an interesting result, right? Back in 14 or 15, when Goldman bought Genesis, we were all like, oh, this is it, right?
Yeah.
This is it. The institutions are coming, right? But then that didn't really. It was kind of too soon.
Hmm.
Um, but I think now, I think what you need to have, I think the move seems to be is the acquiring party needs to have a pre-existing relationship with the target. That seems to be a prerequisite these days, just like
Yeah.
you guys.
Hmm.
And then the second thing seems to be they have to be somewhat ancillarily related to residential real estate, right? Whether they're a home builder, an iBuyer, someone who's somewhat touching the space, because otherwise you don't have the policies and procedures and infrastructure to build it out, because it's just such a unique business. So I think that's going to be the trend going forward.
That makes sense. This not needing to be or not being the prudent decision for somebody's first dipping the toe in the water. You at least have bought some loan flow from this
I think that's
space,
usually the case. Yeah.
some kind
Yeah.
of yeah,
You've invested somehow in the space, right?
yeah.
And or you've either one thing that kind of someone asked me before was like, why are the home buyers jumping in? Well, home buyers are jumping in. This is automatically the next expansion plan for them, right?
Yeah.
How else are they
Yeah.
going to get their hands on inventory? But at the same time, the question mark is, look at the portfolio. Have they been investing in some of these securitizations? Have they been
Mhm.
investing in some of these funds? that may also be an indicator. So
Yeah. So it's been, not just us, a bunch of companies, like you mentioned, getting acquired. It feels like there's the chance that this is going to cool off sooner than later.
agreed.
You
Yeah,
think so?
I think
Yeah.
so. I think it's not. I mean, here's the thing: cool off is a very tricky word from a securities attorney perspective, right? I think it's going to be a different strategy,
Okay.
right? So people say it's going to cool off. I think it's going to cool off in the sense that you're going to see fix and flip shift gears a little bit, right? Rental is going to be a much more dominant force from when it comes to the loan aggregation model and securitization model. Fix
Right.
and flip, I think, is going to transition to more of a balance sheet move, and I think it's going to transition to more of a on the commercial side, right? In the commercial sector, you see a lot of life companies who have allocations in the space. I
Mm-hmm.
think we're going to start seeing that type of activity happening, and that's gonna change dynamics a little bit. Because you don't. I mean, the securitization model for fix and flip and bridge, it's doable, it's possible, but it's not as simple as a DSCR model a product would be, and it requires a lot of exception work and a lot of kind of creative structuring. So, but it's a perfect tool for balance sheets because it's short term and it's esoteric, but it has all the features that a fixed income strategy would want. So I think we're going to see a shift in gears in the next, I would say, year or two. And that bodes well for the retail lenders who are not necessarily conforming to Wall Street standards, because they can continue to be esoteric and continue to be a little more outside the box, if you will, but also attract that life money. So
Yeah. So how does this translate, 1, 2, 3, 5 years down the road for the investor who's getting loans from the lenders in the
yeah,
space that are getting acquired today? Because you look at a lot of the companies that have been acquired and will be acquired in the near future, a lot of them stocked with most of their original founders and executive leadership team.
yeah,
You have just a new parent coming in, which
hmm
inevitably changes the dynamic, no matter what relationship you had prior. And then the consolidation you mentioned, that think will continue to, or really start happening down the road, which is a kind of common sense. Don't have to stretch the imagination too far to see that that's going to happen. So how do these things culminate to affect the end client,
yeah.
folks who are getting the loans?
At the end of the day, that's the most important thing, right? The borrower
Yeah.
experience, right? And that's the funny part of this space is that, like, when we were talking about multipliers, and acquisitions 2 years ago and 3 years ago, I was arguing, I think it was on a panel actually, I was arguing that you can't use the traditional EBITDA multiplier in this space. This space is more akin to professional services, right? Like a law firm, CPA firm, because at the end of the day, it's the LO that has the relationship, right?
Right.
At the end of the day, it's that book of business that you're looking for. And so the acquisition model where you see in private equity where you acquire, keep the executives on board, gut the team, install new people, that doesn't work in this space. And all the successful models you've seen so far, acquisitions you've seen so far, have kept not just the executive team, but a lot of the core employees, and that's important because you can't lose that borrower relationship if your top LO is let go after an acquisition and he moves to a competitor. Where do you think those borrowers are going to go? The borrowers don't care about the parent company. They like working with that company because Bob Smith, the LO, is taking care of them, the builder,
Yep.
right, the flipper,
Yep.
the investor, right, and so.
Mhm.
I always tell people, listen, if you're gonna be acquired, and the term sheet says, there's no discussion about employment and the executive team and the officers and all the other employees in your company. If you aren't planning for that at the beginning, the term sheet phase, you might as well, unless you're walking away from the business,
Mhm.
right? You might as well say another deal because your business is gonna cave,
Yeah.
right? Those relationships, those business relationships, especially in fix and flip, right? It's that repeat builder relationship, repeat borrower relationship that everyone wants,
Yeah.
right? And so you cannot risk that. I think that with consolidation, one of the most things that easiest things to overlook is going to be that, right? And so it's going to be very important on both the acquiring side and also the selling side to remember to keep those key performers in place, because if you're a borrower right now, if you're a borrower, I mean, you have every opportunity to get the best deal possible, right, for yourself, whatever that means. That could be speed, that could be price, that could be service, it could be anything, right? Whatever floats your boat as an investor, right?
Mm-hmm.
Well, there's never been so much opportunity on that front, right? So you as the lender need to understand that you need to make it easier for your borrower to work with you,
Right.
and you need to keep them sticky. So if you're going to sell your company, you need to be very cognizant of that to the minute level. I've seen so many people overlook that issue, and they don't think about that, and they think about this as kind of they view this as a private equity play, and it's different. This is a book of business kind of model. You cannot devalue that.
Yeah. Yeah, it's become so much. I've been in the space 6.5 years, and so much more commoditized now than it was when I got in 6.5 years ago. Our
Mm-hmm.
product development, we could make, one or two changes to a rate or fee or leverage,
Right.
and just be knocking it out of the park, and the best crew in town. And it would take a couple months before another group would pile on and beat us out in a particular strat. We go back to the drawing board. But now your top lenders all play in the same pool, more or less. So yeah, it is. We had a customer experience consultant come in a couple years ago, and her biggest advice, uh, very simple and something I think easy to forget, though, is you want them to do business with you as the person, right? It's easy for somebody to say no to or break up with ABC Lending, this
Yes.
company name, but it's a lot harder to look Dalton Elliott in the eye and do that, or try to not work it out,
Yep.
right?
She's
So
right. I mean, people do business with who they like, and
yeah.
and the mortgage industry as a whole has forgotten that. The one thing that private lending has stuck very, very hard onto, and I think this is because we're so fragmented and we have so many different product offerings, is
Mhm.
we're so obsessed about those business relationships. But you see that lose its touch a little bit as these companies grow and grow, right?
Yeah.
They're trying to get to a level of scale where that doesn't matter anymore in their mind, and that's furthest from the truth. So
Yeah.
and all this is all of the successful large companies that we talk to on my show, and I'm sure you have as well, all talk about that, right? That sticky borrower relationship, that customer service. You cannot forget that in this space, because Bob Smith, the borrower, Bob Jones, the borrower, can now just shop your deal everywhere else the second he feels like he's being treated as just another borrower.
And the easiest way possible, in 5 minutes on the phone, sitting on the couch, you can get
Oh yeah.
3 quotes from 3 different lenders.
And
And
everyone's optimizing their online presence so they can really they can find out Bob Jones is shopping.
yeah,
So it's it's never been a worse time in that context. Like, you have to be super vigilant when it comes to your customer service and your borrower relationships, and you see that, and a lot of companies are now really doubling down on kind of account executive level people and really paying a premium for those books of business. So
yeah, I have never, in my experience at Lima One, have never been busier on the product development side, the sales training side, the tech side. We have IT meetings every single day. We have stand-ups 5 days a week.
right,
So sometimes I want to tear my eyes out,
yeah,
but you have to keep every single one of those balls moving towards the end zone, because everybody else is, right. We're in South Carolina, so all of our competition in Florida and New York and Texas and California, you assume that every lender over the fence is doing that, and if you're not doing it, you're going to fall apart. And the make it easy piece that you talk about, I'm director of sales and customer experience, and on the CX side of the fence, I have 72 font written in my office. Just make it easy. It
yeah.
has to be the cornerstone of everything. It's like, from a borrower's perspective, make everything as easy as possible. Every touch point, reduce the number of total folks that they're working with, because it's just so easy for somebody to go somewhere else now.
Yep.
You got to set yourself up for success.
Years ago, Nima and I were on a panel. We're talking about, Amazon was smart. They did buy with one click, right?
Yeah,
You can buy something with one click. Right?
that's so
And we
true.
challenge the audience: what are you doing to make it easier on your borrower, right? To optimize the underwriting, because that's the most painful process, right? The underwriting process,
Mm-hmm.
and get him an approval as fast as he needs it to be. And what are you doing to optimize it with your long-term relationships, right? So
That's
it's so challenging, because you're right. There's a hyper competitive world, and there's also so much technology out there right now that's built for the mortgage space. So
Yeah.
But it also creates an exciting time. We all get together and we're all seeing what each other's doing. And it's all pushing us to get better, So
Yeah, yeah, and so much room to try new things, and not everything, of course, like not everything you try works out, but just
that's very true
pushes all of
too.
us to be more creative and think outside the box. Whereas just tweaking, like, oh, we're not as competitive as we were 2 months ago. Let's lower rate, lower fee. It's way
That's
beyond that
that's
now.
conventional space, right? That's how it's done on the
Yeah,
conventional side, and it always drives me nuts to see those guys like all. There's so many of them, and they're so standardized. They're literally selling the same widget, just with one little twist compared to everybody else, right? And
yeah,
I fear that for our space. Thankfully, fix and flip and bridge and construction is more commercially oriented, I feel like, and
mhm,
so that gives us a little more room. I feel like personally. So I'm
yeah.
not envisioning a mass standardization in the space, unlike some of my colleagues. So
There you go. I'm with you. It doesn't seem the direction we're headed. Just don't
I hope
feel it.
so.
Don't
I
see it.
really do.
Yeah. So let's talk about the fun side of the business.
Yeah.
FUND. Walk me through kind of an ELI 5. Explain to me like I'm 5. What is a fund? How does it work?
Yeah.
What are the benefits and the downsides and the treacheries? Give me the
Yeah, I
dirty.
mean, I like the way you put it, right? 'Cause the simplest idea of a fund is essentially if you're an investor, right? Whether you're an investor who's retail and buying a few houses, or you are a seasoned hedge fund manager, right? The idea is that you want to be able to have more buying power,
Mhm,
and you personally don't have that much capital; you're limited, right? Well, the idea is, can you go out there and raise and pool money from other investors, right? Whether they be your friends and family, or other family offices or other institutions, pool that capital together and acquire more of the assets that you're pursuing in exchange for a rate of return to the investor, right? And that's what at the end of the day, whether it's a hedge fund, private equity, NPL, mortgage, real estate, at the end of the day, the goal here is to create a pool of assets that generate some type of return on capital, and it's funded by pooling investor capital into one vehicle, into an entity, right? And it can be done via an LLC structure. It can be done via some kind of creative debt structure. Either which way you do it, the idea is to pool the assets together to have more buying power and to have more return, right? And also to spread the risk, right? And so,
mhm,
in the world of mortgages and in the private lending side, the market used to not have as much capital, and a lot of investors um, loved the industry from a return standpoint, and they wanted to get in, but they didn't want to become a lender themselves. Lo and behold, the fund model translated over from real estate and from the conventional side and the subprime days, and it models a very similar 2 and 20 hedge fund model, nothing crazy. And the idea is that the sponsor will go out there and raise money from as many high net worth investors as they can into an LP or an LLC, and then that LP or LLC will go out and either invest in or fund loans and hold them on its balance sheet, and that will generate income, right? And that income is returned to the investor on a monthly or quarterly basis. And so the beautiful part about this strategy is from an investor standpoint, and this can also be done for real estate, right? You invest in, we're going to invest in 10 units, 10 pieces of multifamily real estate, value add, hold, stabilize, rent, and then eventually sell. And
mhm.
we're doing that in a larger pool instead of doing one-off assets that are smaller. I can scale up my business, right? And so,
Yeah.
well, at the end of the day, though, it gives you more buying power. It lets you spread risk across the spectrum. But also for you as the investor, from an investor standpoint, it gets you access to an industry that you normally would not be able to get to, or you'd be stuck to buying stuff that's on Wall Street that has loads of leverage, loads of fees, and it just really isn't your cup of tea, right? You have really no say as to what they're doing. Whereas a lot of these funds are still, even if they're managing $1 billion, they're still managed privately, right? And so
Mhm.
there's that benefit, and so the investor can really pick and choose based off of their appetite. On the sponsor side, you get a lot of horsepower by raising the money, and not everyone can raise money. I keep telling people, like, a fund's not for everybody, right? The idea of a fund, you have to be committed to going out there and raising money, whether it be from retail friends and family or retail investors or the larger investor, right? You still have to be able to do it and commit time to it and commit energy to it, right? And
Yeah.
so, if you can, you can become, some of these, the equivalent of some of these larger, real estate or mortgage operators, much like Lima One, right? And scale and scale and scale, right? And we've been part of that story for many of our clients, and they started up literally just, hey, I'm new to the space, starting my own lending business. I've been brokering some deals. I want to start a fund, and now they're managing 200, 300, 400 million, and originating, sub 1 billion to Wall Street and all that other, and they have multiple credit lines, and their business has evolved, right? They have truly a mortgage business, and it's one piece of that puzzle. So.
How has activity in that been through the pandemic, through today? I imagine just on fire like every other part of the industry.
Yeah, I was on a couple different panels talking about this. The fascinating part about people who have discretionary capital and balance sheet capability, and we're not so reliant on Wall Street, where the pandemic didn't slow them down, right? March happened to everybody. I feel like March was a reality for everybody. We all kind of like popped our heads up and be like, all right, something's wrong. Let's take a breath and figure things out. But unlike a lot of our folks who are really dependent upon Wall Street, our balance sheet strategy, our discretionary capital, our fund managers, they were able to get back out there, as soon as end of March, early April, even charge higher rates, lower their risk, and they thrived. One of my clients was on my show, Noah Broch, is a capital fund in Arizona. He had a record year. And the nice part about it was, it allowed him to grow the portfolio and attract new investor classes and grow even more. And now he is, flirting with some really big opportunities, and his colleagues are kind of in the same boat. And so that was the interesting part to see. And also at the same time, some, interesting tax laws that came out in 2017. So people were able to take advantage of that. And investors, the investor market, the retail investor market was really, really looking for something like this, because you think about what they've been investing in so far, there's just massive volatility all over Wall Street. The S&P is doing just fine, but it's just all over the place. It's just what's going on. Every core index is just kind of so volatile. I don't know what to do, right? And aside from Bitcoin, which is all over the place, people are like, oh, Bitcoin this, Bitcoin that. One of the things that was being talked about was, well, let's look at real estate, right? And so we saw a lot of the core markets that were not impacted by the pandemic do very well. And our space was one of them. And that allowed the industry to really jump back on its feet with, I would call it just massive fervor in June, July, right? And so here we are today. The market's never been hotter on both sides, right? Whether you're working with Wall Street, whether you're balance sheet, both sides of the business are just doing gangbusters right now. And I think it has to do with confidence in real estate. I think it has to do with confidence in this asset class, right? And I think it's just going to get better over the next, I would say, 2-3 years. So
I didn't even think about the points you just brought up about kind of April, May, June. That if you had a fund model, you were good to go, right? That
if you had discretionary capital at your whim and call, right? You can make a call right there. You don't have to worry about it.
Yeah.
And you guys talked about this on my show. Like, you guys weren't that impacted either, right? And so you had the ability to get out there. But a lot of folks were 100% reliant on Wall Street.
Yeah.
Right. And so that taught a lot of lessons. And we're a reflection of that too, right? So my practice is a reflection of that. We had a record year last year too. We created more funds than we had ever done before, specifically debt funds. We do a lot of different things, right? Last year was just the year of the debt fund, and also the year of the mortgage REIT, and so many were stood up last year because of that. So
yeah, it's wild. So Reg D, before I just dropped the bomb out there.
Oh,
man, hard break on the fun talk and hit the gas.
It's relevant. It's relevant
on this.
Yeah.
It is. It's ever relevant. So Reg D, you're going to explain it much better than me, but my basic understanding of it is that it prohibits self-directed IRA investments in real estate. Is that
okay? So Reg D is the regulation that we're all using. There is a hashtag going around that Nima and my partner Nima and I started called Save Reg D, and so this has to do with the Build Back. I'm gonna put air quotes. Build Back Better Act, right? Put out by the Biden administration as part of this joint legislative effort to pass the $1.5 trillion infrastructure bill and the $3.5 billion budget bill. And this is part of the $3.5 trillion budget bill. And so everyone was all in the news. Everyone saw in the news 3.5 trillion this, right? Tax raise this. We all saw that, right? And I can go on and on about the taxes. And I'm pretty conservative myself, and not really that interested in seeing taxes go up. But that's not the focus of what the law firm's kind of mission is right now. The hashtag Save Reg D is part of Geraci and the American Association of Private Lenders Government Relation Committee's effort to raise awareness and contact our congresspeople about sections 138312 and 138314 of the Build Back Better Act, right? And these two sections are really, really bad news. Really, really, really bad news. And what they're they're specifically tailored to IRAs, right? They're designed to essentially put I would say ankle bracelet or handcuffs on an IRA investor. And so take us back to June of this past year, right? Peter Thiel got in the news because he had some ridiculously large IRA, right? Some ridiculously large Roth IRA. And that and many other billionaires, right? And what the story was that they had invested, the proceeds from one investment, a small amount, into a larger investment. They netted a very, very large check, all done via an IRA, and so no taxes. Well, apparently Democrats didn't like that too much, and so they proposed, as part of the Build Back Better Act, was number one, we're going to prohibit IRA investors to use their IRA to invest in any investment that has a net worth requirement or that offers securities that has a net worth requirement or a financial education requirement, which is essentially Reg D. Right? There's no other regulation out there that has a net worth or financial education requirement. So when I read it, I was like, wait a minute, they're going after Reg D on this. And all the IRA custodians were freaking out. My fund manager clients were freaking out. And I was like, what? Let me read this thing real quick. And it was specifically designed to attack Reg D. And Reg D, for those of you guys who don't know, I think some ridiculous number, like $12 trillion in the past 7 years were raised using Reg D. And so you got to think, it's not just for the the hedge funds and the private equity funds. We use it a lot in the residential mortgage space, but so do our real estate investors, right? Our end borrowers are using Reg D to syndicate these larger pools of real estate or buy multifamily or whatever. And so what this would do essentially would say, if you were in an IRA, you cannot invest in a Reg D investment. And if you are invested, you must divest by, I think, the year like 2023 or something like that. You have to get out. So not only is it an outright ban, but it also requires people who have holdings to divest. And go somewhere else, essentially. Put it in the stock market or something like that, right? And what's frustrating about this law is that this is a tax bill, right? We're trying to raise tax revenue. Okay? I get it. Fine, right? That's fine. What does this do? This does nothing. Literally nothing. Not only does it raise no tax revenue, but it's essentially telling people with their hard-earned money where they can and cannot invest. And who does it serve? It serves Wall Street. It is counter. It's kind of funny because, in my opinion, it's counter to the Obama administration's Jobs Act agenda to democratize and create more means of private investment. So we're really mobilizing hard with AAPL and really trying to get our audience out there. So if you're in the state of Arizona, especially, contact your local congressman, contact Senator Sinema, and really put it out there. If you're interested in learning more, you can go on our website, GeraciLawFirm.com. We have a big campaign going, Save Reg D, because this is not just for the mortgage space. This is actually for every private investment that you can possibly think of.
Yeah, such a massive story that's not getting enough attention in the space. I think it's so easy for the actual impact of this to get buried and ignored under the billionaire has, I can't remember the number, but it was 9, maybe 10 figures in the IRA, a massive amount of money. So
and that's what I'm saying. If you guys want to get rid of checkbook control or you guys want to get rid of backdoor Roth, fine. right?
Yeah.
I get it. I don't necessarily agree with that either, right? But this is an outright ban. Like, this is stupid. Like, this is, you're trying to penalize that tiny 0.01% of the population, and the ramifications are going to be just massive. I mean, even I have my own, IRA, and I'm an attorney. There are so many. I mean, how many of our borrowers, right, or our clients' borrowers, are holding their real estate holdings in an IRA? Right?
Yeah.
Not just the rental, the flips, and how many of our investors across the spectrum, whether you're Wall Street or they're invested through their IRA. This is ridiculous. I think this is going to be the worst thing to happen to private investment. I mean, since the 33 Act was installed, in my opinion, but I mean, we have a lot of things going for us, though. This bill is not really likely to pass as it stands right now. So we're telling everyone, stick to it. Contact your congressman. If you're in Arizona, especially, contact your congressman and senator, because this is not going to go anywhere. It's going to come back in some form.
Yeah, I mean, the bill in its entirety, a minefield of conversation, but the Reg D part of it, just the implications from it, ill-conceived and a scorched earth approach. I think it's so blatantly clear what the knee-jerk objective was, and the massive fallout if it passes as is. Devastating is not a hyperbolic word to attach to what effect this will have.
And you got to think about this: like 12, the stats that the SEC put to Congress. Congress asked for a report. The SEC put a report to Congress last year on when they were improving Reg D, and they found there's $12 trillion raised through Reg D, right? And a big chunk of that was in private funds, right? I mean, but this is also used by startup companies. This is also used by real estate developers. So this is so counter to it. And the funny part is that it raises no money. It literally $0, right? All it does is ban you from doing something, which is just it frightens me of where we're going with this, because clearly, right, it serves the interests of the Wall Street type funds where you're free to invest in that. But I think it's a dangerous place to be, but thankfully, the bill is kind of not moving forward just yet. We've heard that although the temporary debt ceiling increase, it's not all one package anymore. So there's a high likelihood that this is going to go back to the drawing board. They're going to renegotiate the terms of it. But my fear is that because this is so kind of buried in the bill, in the summary, it's like on the last page of it, it's about something that no one really understands, right?
Yeah, high risk item because of
right. It can be overglossed very easily, right? Everyone's going to pay attention to the capital gains rate and the income tax rate and the penalties and all that kind of stuff, and they're not going to pay attention to this. Yeah. But if you have any stake in private investment, this is going to be a big game changer. I mean, I have so many clients that have most of their offerings are funded through IRA investors, self-directed. It's just a huge marketplace.
Hashtag save Reg D, right?
Very much so. Very much so.
See
Hashtag save Reg D. Check out our website. We have a lot of literature there. But more importantly, get that, send it over. But if you are in the state of Arizona or if you are in the state of West Virginia, Senator Manchin and Senator Sinema have vocally opposed this bill. And so we encourage you people to call and make your voices heard.
I love it. We'll see if we can get Save Reg D somewhere in the video here.
Yeah,
somewhere
man.
Up,
like
down,
that.
corner, top,
Appreciate
bottom.
That.
For sure. So on to some more important business. I hear your favorite films, Dark Knight, Ode to My Father, and The Rock.
Yeah.
Is there truth behind this? So I loved The Rock growing up.
Oh, man.
It's beautiful. Sean Connery, Nicolas Cage, Ed Harris.
Oh, yeah.
Just some hits.
I mean, heavy hitters. But for me, it was like, they're reloading. I never watched an action flick where they actually reloaded. I'm like,
oh yeah,
reloading. This is awesome. So that was the reason why I love that movie so much. The little details,
Yeah, I love it. Now I also love Dark Knight, one of my favorite movies. Daniel Craig just wrapped his last Bond movie, I was out at lunch earlier with some colleagues, and I was like, Daniel Craig will be our Bond forever because throughout our years as young boys, and that was our James Bond, right? Pierce Brosnan at the very beginning, but
Yeah.
Daniel Craig is our guy and always will be. And in that same vein, even though the spectacular Clooney Batman, Michael Keaton,
The chin was so good.
Michael Keaton, Val Kilmer, like Christian Bale, he's the Batman of my generation. Ode to
He's
My
the best
Father.
Batman, in my opinion. I really do believe that. I mean, this whole DC cinema, Ben Affleck Batman's pretty cool, but you can't beat Christian Bale. I mean, you just can't. I mean, he's awesome. He's a great actor too. So
Yeah, I love it. So I have a couple of quirky questions here,
yeah,
if you
go
don't
for it.
mind. So who's playing Kevin Kim in a movie? Who's
Oh, that's a good one.
who's suiting up to play you?
I don't know if you guys have ever seen. Oh man, it's on Netflix. I forget the movie's name. It's I can't remember. The actor's name is Randall Park. He was in Fresh Off the Boat. He's a dad in Fresh Off the Boat. He was in Always Be My Maybe with Ali Wong, and he's actually like one of the most like hilarious Korean American actors out there. And he also
Oh
makes a lot
yeah.
of dad jokes, right? And so I feel like if anyone were to play me, I'd want him to do it. But beyond that, I mean, I don't know. I mean, besides Randall Park, I mean, you know, someone told me that I forget what his name was. There's another really really well known actor. It's the guy, I forget his name. Oh yeah, so this is the guy who played Oddjob. Kind of a burly Asian dude.
Yeah.
They said you should be played by Oddjob. That guy. But speaking of James Bond, but yeah, I mean, that's probably it.
I can see that Randall Park. That's a good pick. It's
Yeah.
my aspirational one would be Daniel Craig. I
Oh yeah, I can see
I
it.
I think I have a little more room to fill out in the sleeve of this, the bicep of this polo before that actually makes any sense.
No,
Dude's
but
20 years older.
he has some movies where he's pretty thin. He thins out, and you know, thin is in, man.
Yeah,
It's all good.
but pre-Bond days. But
Yeah.
since he came out of the ocean in that blue,
Oh,
we'll call it a swimsuit. I don't know
he
exactly what to
added
call it.
like 80 pounds of muscle for being on Bond, right?
Man, yeah, he's different beast now. So even though he's like 30 years older than me, and in 10 times as good a shape, that'd be my pick. You travel a bunch. I met you on the road. I think I met you in
Yeah.
Vegas at AAPL many years
Many,
ago.
many years ago.
And what are your travel rituals? Is there something you
Oh
do?
yeah.
Yeah, to walk me through your travel
A lot of them.
rituals.
A lot of them.
Yeah.
Yeah. So I travel a lot, but I have two young children. One's almost 4 and one's 11 months.
Mhm.
So there has to be a whole explanation. Where am I? I'm going to be gone for a couple of days, and they're kind of excited because they get mommy all to themselves, right? So that's the first part. Packing of the bags, right? You have to
Mhm.
make sure. I have to make sure I have. I don't usually wear hair product because I just I fear losing my hair, right? So my dad's bald, so I always forget to pack it. I've forgotten a few times, so like I always make sure I have my hair product. I always make sure I have some type of Geraci gear with me: a sweater, a golf shirt, a magnetic pin, something, right? Got to rep the
Yeah.
brand. And then if we're going to Las Vegas, which is like 90% of where I go, right? I always pack a little it's a little portable humidifier, because if you spend more than a day in Vegas, you'll know it's like just the moisture gets sucked out of you because it's so dry,
Yes.
and the air conditioning and the smoke, and it's just so it's a little like the size of a little like Bluetooth speaker. You stick a
Mhm.
bottle in it, you plug it in, you put it next to your bed. It's saved my voice, saved my face, saved my lips. It's the best thing ever. And then the last thing is must have is TSA PreCheck. I
Yes.
I will not travel without my TSA PreCheck because I refuse to stand in line like a regular traveler. Take my shoes off, my belt off, and yeah, that's a must for me. So
Yes, and
besides that, I mean,
anybody, yeah. If you're listening and don't have TSA PreCheck, do not go get it because we don't need any longer lines. It's
yes.
the best kept secret in travel. It
Oh my
comes out
God.
to like $17 a year
Yeah,
is what the
most credit
annual.
cards pay for it. So like my credit card
Right.
covers it.
Yep, same. It's 85 every 5 years. And I just got back from a trip last week and was telling my wife, I was like, if they charged $500 a year and I flew twice a year,
Yeah.
I would do it. It's a time
It's so worth it.
saver. Yeah, it's a convenience. Like you said, you don't have to strip down half naked in the airport
Yep.
and be accosted.
And for me, I pack a lot of stuff in my carry-on, and having to pull your backpack out, I having to pull your laptop out and other stuff. It just causes all kinds of things. And the worst is when they make you take your belt off. I feel like that's the worst. Like,
Yeah.
you never know when your pants are gonna fall down. You just gotta hold your pants up. It's just it's not
It's just I'm an adult. I'm just trying to travel and do a respectable
right.
thing, and I'm getting
Right.
treated like a criminal. I'm not doing anything wrong.
Exactly.
So I
Exactly.
love it.
You
I
need it.
have
You need it, especially when you go to Las Vegas because the McCarran Airport TSA line is like
yeah,
there's nobody in it. Literally
yeah,
nobody in it. You just walk right through. You can get to your flight like 30 minutes before and just walk to the gate. It's great.
yeah. It is a lifesaver. Have you had to get back in packing shape?
Oh yeah.
Like,
Oh,
yeah,
yeah.
I was surprised. I went to Pitbull conference in April of this year, April 2020, 2021, and 6 months ago. That was the first work trip. And I was there. I went down a couple days earlier with my wife, just hang out in Miami. But so I was there for maybe 5 days. I feel like I packed for a summer in Europe.
Yeah.
I got to the hotel. I was like, I have way too much stuff. And every trip, I think this last trip, I finally got back into bare essentials
You
where I
know
got
what you
home.
need.
Yeah, everything went to the laundry because I wore everything, didn't have any excess. I think I had an extra pair of underwear and socks, which is always, you always
Yeah.
overpack those two essentials.
Yep.
Yeah, it surprised me how there's an art that can be
Oh
forgotten
yeah.
if you're
Even
not on
how
the
you
road.
fold things and like I use the old fashioned garment bag, like the
Oh
folding
yeah,
garment bag from the 90s. My dad gave it to me and it's the best because it's a suit. Traveling with a suit is the hardest thing, right? It's
yeah,
figuring out how to do that again. But I'll tell you this much: the worst thing for me was having been at home for a solid year, not on my feet, and then I went to my first conference. It was actually our show in March and in Newport Beach, and I was in dress shoes all day on my feet. I'm like, my feet hurt so much. What the hell? And it made me realize, oh my God, I've been sitting down for a solid year and at work from home, I haven't had to do this, so my body forgot how to conference.
I know, out of conference shape. Same thing.
Yeah,
We were at IMN Miami, and you know how like if you are sponsored at a certain level, you have a private meeting room above
yeah,
the ballroom. And midday through the first day or mid afternoon, I went up there, and Courtney, Courtney
oh yeah.
Newman's, sixth employee here, travels all the time. He was plopped down, just sprawled out in a chair. I was like, "What's up? What's going on?" He's like, I'm dead tired. He's like,
Yep.
"Guys, this is
You don't have the
yep,
endurance
same."
anymore. My voice, I lost my voice really, really soon because like, what the hell? And then the one thing that I did gain was the ability to drink more.
Yeah, yes, same. That's
My
the one
tolerance went
positive.
through the roof because I drank so much during COVID.
Yeah, I usually would just pre-COVID, I would have no more than 2 drinks at the networking hour because then you had dinner and then you're going out and stuff. I had
Yeah.
2 drinks, flew through those. I was like, I don't know, get back. Let's go. We got to hit 4 or 5 before we get dinner, and then
Yeah, exactly.
we'll get out.
Exactly. But
I
it's
love
cool
it.
though. I mean, the nice part is what I was worried about this year was, how are we all going to react? And I think what we all realized was like we need to get in front of each other. We can't.
Yeah.
We have to. Like this whole idea of being behind a Zoom screen to do business it only goes so far.
Yeah. Yeah. It is great to be back in the wild. I will see you in less than a couple of months.
Yep.
Cannot
We'll be
wait. Yep. That's
Scottsdale.
it. I love it.
Yeah.
Hey, Kevin Kim, partner and face of Geraci. Always a pleasure chatting with you, my man. Thanks so much for joining.
Thanks for having me on, man. I really have fun.
Absolutely. Take care. Talk soon.
All right.